This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 424. Today's episode is brought to us by SoFi, the folks who help you get your money right. Paying off student debt quickly and getting your finances back on track isn't easy. That's where SoFi can help. They have exclusive low rates designed to help medical residents refinance student loans. And that could end up saving you thousands of dollars, helping you get out of student debt sooner. SoFi also offers the ability to lower your payments to just $100 a month while you're still in residency. And if you're already out of residency, SoFi's got you covered there too. For more information, go to SoFi.com/whitecoatinvestor. SoFi student loans are originated by SoFi Bank, N.A., member FDIC. Additional terms and conditions apply. NMLS 696891. All right, welcome back to the podcast. This one drops on June 19th. I'm recording it the week of Memorial Day, though. It's been a heck of a month for me. I've been having a lot of fun trying to see if my wrist still works mostly. I've done some traveling, got to do some paddling, went and rode a river actually this week, did 117 miles on a river in 2 days. Let's just say it was pretty high water on the Middle Fork of the Salmon this last week. And I've been on a couple of canyoneering trips. So I'm pleased to say that my wrist still functions. It's not quite the same as what it was before, but I'm still able to do most of what I love to do. So that's been good news for me, and it definitely has me in some better spirits. Also excited because it's graduation time. By the time you hear this, it'll be well past this, of course, but my daughter graduates from high school tonight. So we're thrilled about that. She'll be speaking, as well as my wife, who's now on the school board. So I'm thrilled to be able to hear both of them speak at high school graduation tonight. So lots of fun stuff in our life. Okay, let's do some updates. First is an update from Chris Davin. You'll recall we had him on talking about, some pretty out in the weeds stuff on taxes a few weeks ago. Well, he did write back to make sure he gave this update. He said he was going to do this about the home office deduction. You'll recall the home office deduction is something that some doctors take, and we had a discussion on the podcast about whether you had to actually do work at the home office before and after work at your other place of business if you were going to deduct the mileage from your home office to your other sites of work. And Chris's conclusion after he did his homework assignment was that if one has a legitimate home office, there is no need to use it before and after each trip from another work site. Okay. You don't have to send an email after getting home from the hospital to deduct the trip. He went to IRS publication 463, which is about travel, gift, and car expenses. And this is what it says. It says office in the home. If you have an office in your home that qualifies as a principal place of business, you can deduct your daily transportation costs between your home and another work location in the same trade or business. And daily transportation expenses you incur while traveling from home to one or more regular places of business are generally non-deductible commuting expenses. However, there may be exceptions to this general rule. You can deduct daily transportation expenses incurred going between your residence and a temporary workstation outside the metropolitan area where you live. Also, daily transportation expenses can be deducted if you have one or more regular work locations away from your residence, or two, your residence is your principal place of business and you incur expenses going between the residence and another work location in the same trade or business, regardless of whether the work is temporary or permanent, and regardless of the distance. Neither of those, he says, mention a requirement to use the office on the day of travel to make the trip deductible, which leads me to believe there isn't one. He also went to IRS publication 587 about a qualifying home office, which applies to many white coat investors. And this is example 3 there, which is that Taylor is a self-employed anesthesiologist. Taylor spends the majority of the time administering anesthesia and postoperative care in 3 local hospitals. One of the hospitals provides a small shared office where Taylor could conduct administrative or management activities. Taylor very rarely uses the office the hospital provides, but instead uses a room at home that has been converted to an office. Taylor uses this room exclusively and regularly to conduct all of the following activities: contacting patients, surgeons, and hospitals regarding scheduling, preparing for treatments and presentations, maintaining billing records and patient logs, satisfying continuing medical education requirements, reading medical journals and books. Taylor's home office qualifies as a principal place of business for deducting expenses for its use. Taylor conducts anesthesiologist-related administrative and management activities there, and at no other fixed location where substantial administrative or management activities for this business are conducted. Taylor's choice to use the home office instead of the one provided by the hospital does not disqualify the home office from being the principal place of business. Taylor's performance of substantial non-administrative or non-management activities at fixed locations outside the home also does not disqualify the home office from being the principal place of business. Taylor meets all the qualifications, including principal place of business, so the expenses can be deducted for the business use of the home. And apparently that mileage as well. Okay, hope that's helpful in clearing that up for those who are wondering about that. It's not a huge deduction, but it's not an insignificant deduction. I mean, it's close to 60 cents a mile last time I looked it up. And so, business mileage can be a pretty awesome deduction if you legitimately qualify to use it. Okay, also, I think Chris mentioned during that podcast that physicians in California are required to be an S Corp. And that sounded a little odd to me. And somebody wrote in and said, I don't think that's the case. My large group in California has a significant percentage of sole proprietors. And I'd be curious to hear if there's something I'm missing. Well, I decided I better look it up. And California has kind of a unique no corporate practice of medicine law. And basically what that means is that a doctor cannot practice as a simple LLC or a simple corporation. Right? If they're going to be an LLC or a corporation, it has to be a medical corporation or a professional LLC. And some other states have the same law. So it's not a huge difference between the two. They're basically the same, but it has to be, this medical or this professional version of those. But that doesn't mean they can't be a sole proprietor. They can still be a sole proprietor. They don't have to form a corporation to practice medicine. But if you do form a corporation, it needs to be a special California medical corporation. Or if you form an LLC, it needs to be a special California professional LLC. I hope that makes sense. Okay, by the way, those of you out there looking for a relatively simple and very flexible, but potentially profitable side gig, you should go to whitecoatinvestor.com/survey. If you're a doc, people want your opinion and they'll pay you for it. And these companies are treating doctors better and better and better all the time. And in fact, we update our list. We take people off that, don't work well with doctors. We put people on that are new. And so let us know your experience with these various companies. But if you go to whitecoatinvestor.com/survey, you can apply with all of them. And some specialties, this can work out very well for, particularly if you tend to prescribe expensive medications. If you're a rheumatologist or a neurologist or those sorts of specialties, your opinion is pretty darn valuable to a lot of these big pharma companies. And so they'll pay you for it. But check that out. That extra money helps you do whatever, save for retirement, have more to spend. It's technically self-employment money. So, if your business is doing surveys, you can open a solo 401k for that business. That might give you somewhere to roll over some big SEP IRA you want to roll over so you can do backdoor Roths or something. But check that out. Okay, let's do some speak pipe questions. This one is what's on everybody's mind, at least if they have federal student loans, which is what is going on in Washington. Let's listen to this version of the question.
I hope this finds you well, Dr. Golly. The Trump administration has blocked IDR applications this past week. You stated Trump could not block PSLF without an act of Congress. But if this persists, effectively no borrowers will be able to pursue PSLF. Is this true? It also does not seem readily apparent how recertification of income will be impacted, which I do this fall. I have approximately 3 years left until forgiveness on my loan, and will end up on the max payments this year anyways once my recertification hits. Will I be impacted? Thank you.
I understand the anxiety that people have when they have been counting on, public service loan forgiveness, income-driven repayment programs to be their student loan management plan. And then things in Washington start happening. A different political party gets elected to the White House. A different political party gets elected to the Senate. A different political party gets elected to the House. Chief justices change. Supreme Court justices change, right? And we wonder what's going to happen. As a general rule, don't panic when you hear stuff might happen in Washington, okay? Wait until something actually happens, okay? And at that point, evaluate if you need to adjust your plan. Now, ideally, you've incorporated a lot of flexibility into your plan. For example, one of the things I've been telling people for years about public service loan forgiveness is to have a PSLF side fund. You know, when you come out of training, you still got to live like a resident. You still got to make these huge payments to your lender. Except if you're going for PSLF, you make those payments into your brokerage account. Okay, so you still have the same money that someone saved up and paid off their student loans in 2 or 3 years has. It's just in your brokerage account because you're hanging on to see if PSLF is going to pay off for you. Now, that allows for a few things. One, it allows your career to change. If you decide, I just don't want to work for a PSLF qualifying employer anymore, it allows you to go get a new job and use that lump sum of money to pay off your loans. On the other hand, if something changes in Congress or something changes by executive fiat, it enables you to go, you know what, this isn't the right plan for me anymore. I'm just going to pay off my student loans. Luckily, I've got this $180,000 I've been saving up for the last year and a half that I can use to pay off my student loans, and you can move on. So that is the solution to uncertainty, is just be patient, let things work their way through the courts, let things work their way through the halls of Congress, and see how it really all boils out, right? I'm hesitant to even answer this question because right now it's the last week of May. And when this podcast drops on June 19th, well, Congress has probably done something with the big, beautiful bill. It's has passed the House now and is sitting in the Senate last time I checked. I don't know what that's going to do. I don't know what the final form is going to look like after it goes through the Senate and then they reconcile it with the House version. If it gets out of the House and the Senate, I'm sure President Trump is going to sign it, and it will have some effects on student loans. But if I had federal student loans, I wouldn't do squat with them until this thing works its way through Congress and is signed by the president. And then once you know the rules of the game, you can start playing the game. Right? I certainly wouldn't bail out of PSLF if that was otherwise my plan and refinance my loans, right? Because once you refinance, you can't go back into public service loan forgiveness. Now, getting into any more than that is just speculation on what these policies are actually going to look like a month from now when you're hearing this podcast. And I don't think doing that's going to do you any sort of real service, number one. Number two, I'm going to have to issue a correction in another month, and then you're not going to hear that for a month after that because something I say is going to be wrong because Congress did something differently. So a few things you can do if you are really trying to get as many payments in toward PSLF as you can, but your payments are currently in a program that's under Forebearance, you can get in a different program. So we see people going from SAVE into IBR lately just so they're continuing to make payments while their payments are relatively low. That might be worthwhile to do while this is all being sorted out. But for the most part, let it be sorted out. Let's figure out which IDRs there are going to be. Let's figure out if any of the rules with PSLF are really going to change. I think this is all going to be ironed out by midsummer. And you'll have a pretty good idea of what things are going to look like, at least for the next couple of years, if not for the next 4 years. So please be patient with the federal student loan advice coming out of WCI. We don't know what's going to happen. Our crystal balls are just as cloudy as yours. Right? If you need personalized advice, you need someone to help you run the numbers, go to studentloanadvice.com. Nobody keeps up with this stuff as much as Andrew, the principal over there. And I hope that's helpful. Okay, here's another PSLF related question.
Hi, Dr. Dolly. Thank you for everything you do, the advice you provide, and the encouragement you provide helps reduce physician burnout. I'm currently a family medicine and geriatrician physician practicing in Illinois. I have been in practice for the past 3 years, currently working for a not-for-profit organization. My question is that I am currently part of the loan forgiveness program, PSLF, and plan to provide the 10 years of service. However, my current employer is also providing me with additional loan allotment of $25,000 per year. They stated that in order for them to reimburse me, I have to make a payment. However, due to the Supreme Court rulings, I have not been able to make a payment, and therefore they stated they can no longer continue to provide that amount. I want to ask you if there are any suggestions you can make in the conversation that I could have with them as alternative ways so that I do not lose the $25,000 of student loan assistance that was part of my contract. I appreciate any thoughts, and I appreciate all the things you do for all of the physicians out there.
Okay, a few thoughts. First of all, as I mentioned earlier, don't give up on PSLF, right? PSLF is almost surely going to be available in some form when this all goes through. Okay, we had a kind of a guest columnist write a post about what the world might, there's people out there that maybe aren't totally pro PSLF in the world, was basically what the article said. And we got a bunch of feedback on it that people couldn't believe that we weren't advocating more strongly for PSLF to continue on. Well, I haven't really taken a position of advocating for or against PSLF. There are white coat investors that are totally for PSLF in its current format. There are white coat investors that are totally against PSLF in its format. How it works is very much a political question. That means reasonable people can disagree about it. So in its current form, PSLF is still basically unlimited, right? No matter if you have $800,000 in federal student loans, you can get them all forgiven via PSLF by following the rules and making those payments. So that's your plan. You're working for a qualifying employer. I would stick with the plan for the most part. And truthfully, this $25,000 employer assistance thing doesn't matter that much, assuming that your plan is still PSLF and all your loans are federal, right? It doesn't really matter if they give you the $25,000 and you send it to them or not, right? If you don't have to make payments, you don't have to make payments. The problem with not making payments is actually that it takes longer to get to PSLF. So it may be worth going into IBR, if you're in Save Now, for instance, going into IBR so you can actually make the payments. Then not only do your payments count toward the 120 payments you need, but you get that $25,000. I would also have a discussion with the employer. This probably isn't going to work, but I would have the discussion of changing the contract. $25,000 to the employer is $25,000 to the employer. They don't care if they send it to your student lender or if they send it to you. It costs them the same, right? If my employee came to me and said, hey, I'd rather have my pay in this sort of a form, I don't care, whatever. We'll give you that, right? So have that discussion. It's probably not going to work because it's probably a bigger employer and this is, too much of a hassle for them to do that for you individually, but I'd probably try in this sort of a situation. You should also check to see if you can make payments, because even those people in forbearance can make payments. And if you make payments, well, then you can get that money to make those payments with, in case, heaven forbid, something happens to PSLF or you go to another employer, then you at least your student loans are that smaller amount from making these payments. So those are the things I would try. But otherwise, it may be until your student loans come out of forbearance, you're not getting, your share of that $25,000 a year to make these payments with. So what happens when they change the policies so quickly? It's very hard for anybody to figure out what to do with their own finances. Let's try to get some stable policy. I don't even care so much what the policy is, but let's try to make it a little more stable, can we? Okay, our quote of the day today comes from Morgan Housel, who said, "We think about and are taught about money in ways that are too much like physics, with rules and laws, and not enough like psychology, with emotions and nuance." And that is the truth, right? Personal finance is 90% personal, 10% finance. It's 90% behavior, 10% math. So controlling your own behavior is probably the most important part of personal finance. All right, let's take a question about disability insurance.
Hello, I am a female EM resident about to graduate, and I've been looking for disability insurance. I've been looking at your website and the podcast a lot. I have a specific question for our situation. My husband is an EMIM critical care resident and will not complete training for another 3 years. I feel like I need disability insurance while I'm going to be the sole attending income, but in 3 years when we have a double attending income, I feel like I may not need it. My question is, one, do I still need disability insurance? Should we both get it? And if we don't need it at that point, do I really need a future purchase rider, which it seems is normally recommended, but may not be for our situation? Thank you.
What a great question. First of all, thanks for what you're doing. It's interesting. I was just looking at statistics this morning about emergency medicine, which over the last 6 or 7 years has gone from being a pretty competitive specialty that nobody could ever scramble into to, kind of lower tier as far as competitiveness in the match. A lot more DOs now can match into emergency medicine. A lot more international grads are matching into emergency medicine. A lot more people are scrambling into emergency medicine. Lots of things that went into play for that, one of which was a paper that came out in the Annals of Emergency Medicine projecting, that there were going to be too many emergency docs in a few years. And medical students see that sort of stuff and they react to it. If they're on the fence between anesthesia and EM, well, maybe they're more likely to go into anesthesia. So it's been an interesting last few years for emergency medicine. But I tell you what, the world still needs emergency docs. So thank you to both of you for what you're doing. I love your question. Not every doc needs disability insurance. Okay? What every doc needs is a plan, a financial plan in the event they get disabled. Okay? Now, in my case, when I came out of residency, I was the only one working. Katie was home taking care of our oldest, was pregnant with our second. Mine was the only income. Disability insurance was very important for our family. We were not wealthy, and we had a sole income that was completely dependent on my ability to turn time into money. And so disability insurance, super important for us at that point in my career. Now, some couples are, maybe they're already financially independent, right? We've since dropped my disability insurance policy. I don't have any disability insurance anymore because we're financially independent. We don't need it anymore. Other people have a plan to rely on their spouse, right? This is common for dual doc couples. And there's no right or wrong answer here. Some of those couples decide to each buy a small policy on each of them. Some of them just say, we're not going to have a policy at all, and we're going to rely on our spouse in the event that we become disabled. Obviously, there's some risk there, right? First of all, you got to be okay with half the income. You also have to be okay with the possibility that both of you get disabled, or the possibility that you get divorced and then don't qualify by disability insurance, or just have to pay a lot more for it. So there's some risks to that plan. And other dual doc couples decide we're just going to buy a full policy on each of us because we want the coverage. And frankly, we don't want to spend less money in the event we get disabled. And so they buy 2 full policies. All of those are reasonable things. You just need a plan. This is what we're going to do. Write it down and do that. But this is the nuance in this question I really like, right? It's because one is going to be the main earner for a few years, and then the other one's going to come online when they come out of training. And so, yeah, it's totally reasonable to just buy insurance for a few years. And you're graduating now. I would have told you to buy disability insurance a few years ago. In general, the time to buy it is as an intern, not as a graduating resident. But, maybe you're saying we'd just live off the other dock back then. I don't know what your plan was back then. More likely, if you're like most white coat investors, you just didn't think about it. You were busy being an intern. So I like your plan. I like the plan of not buying, additional purchase rider. But truthfully, the time you usually, buy that ability to increase coverage without being able to prove your insurability is for the policy you buy as an intern. Then you exercise it or buy another policy as you graduate from residency, right? For someone who's buying it as they're graduating from residency, you already make enough money that you can buy as big of a policy as you want to buy. And so I don't know that you need it at that point anyway. But certainly if you're planning on dropping this thing in 2 or 3 years, you don't need the ability to buy more coverage down the road. Another thing to consider is there's at least one company out there that will let you do a graduated premium, meaning the premiums are very low in the beginning and then higher later, rather than a level premium throughout your career. I think most people choose level premiums. I think most companies only offer level premiums, but there's at least one company that will offer graduated premiums. And this is worth talking to your agent about, your independent agent that can sell you a policy from any company, like the ones we recommend, whitecoatinvestor.com/insurance. You simply go, hey, I think I'm only going to have this thing for 3 or 4 years or whatever. So how can we save money, right? Can we drop the, future purchase option? Oh yeah, you should drop that. Can we get the graduated premiums and just make low premiums for 4 years and then just cancel the thing? Yeah, you could do that as well. That's probably a great deal for you. Let's look into that policy, right? Just have this discussion with them. And I think those 2 changes are very reasonable for somebody in your situation. But the first thing is have this discussion with your spouse. What is our plan if you get disabled? What is our plan if I get disabled? What is our plan if both of us get disabled? What is our plan if we get divorced, right? Work through all that, have a plan, and then buy insurance as needed to fulfill that plan. Hope that's helpful for you. Okay, let's talk a little bit about bonds. We're going to change gears a little here. Another question off the speak pipe.
Hey, Jim, this is Srijan from New Hampshire. Glad to hear that you are doing well, and I'm very thankful for all that you do. I've learned a lot from your show. I have a question about bonds as you get closer to retirement. So I understand that during your 30s, 40s, 50s, bonds are a good diversifier based on their correlation with equities. But what I'm wondering is when you're about to retire, are you in bonds for those same diversification reasons? Or is it because you want to have that predetermined cash maturing or coming in at a given time? Trying to help out my dad who might retire in about 5 years. We're trying to decide what to do with new money coming in this year for the bond allocation. Initially, we were thinking to go 50-50 to tips and nominal bonds. For the tips, we were just going to buy them on Fidelity. And for the nominal bonds, I was doing some research and thinking to do either a bond fund like BND or just buy an individual 5-year treasury note. Now, what I noticed is that the total inflation-adjusted return for a fund like BND is pretty close to zero, which got me thinking, why even invest in nominal bonds in the first place? Any advice would be greatly appreciated. Thank you so much, Jim, for all that you do.
Okay, let's talk about bonds. Bonds are one of the two main asset classes out there, right? Stocks and bonds. Okay? Stocks tend to have higher returns in the long run. Bonds tend to have more stable returns. They both have their advantages, both have their disadvantages. It's worth understanding both of them. Now, there's other asset classes, right? You can get into real estate, and there's lots of speculative asset classes out there, art and collectible cars, and cryptocurrency, and empty property, and there's lots of things out there that you can invest in. These alternative investments, if you want. But everyone ought to at least consider owning some stocks and some bonds. Pretty much think everybody ought to own some stocks, and most people ought to own some bonds in their portfolio. There are a few benefits of bonds. One is the returns are much more stable than stocks. Now, I know the last few years it didn't feel like that because 2022 was the worst year ever for bonds. In all of recorded history, 2022 is the worst year for bonds. Why was that? Well, because interest rates went up 4% in like 6 months. Rising interest rates are very tough on bonds, right? Because now you can buy a bond that pays 4% higher. Why would you buy the old bond? So, of course, that one has to be discounted enough until the yield on the two bonds are equal. So when you look at recent returns for bonds, if that period includes 2022, it's because the returns are going to look terrible, right? So if you're looking at returns over the last 5 years, over the last 10 years, bond returns do not look awesome. Take 22 out of the mix and they don't look so bad, though. The other thing to keep in mind is you don't want to invest looking in the rearview mirror, right? The best projection of your future bond returns is the current yield on the bonds. This is for high quality bonds like treasury bonds, right? So if they're yielding 4%, that's about what you should expect as a return out of those bonds. You shouldn't expect whatever they returned in the last 5 years and project that into the near future. That's not the way you invest. Okay? Now, if interest rates fall dramatically, your returns are going to be higher. If the interest rates rise some more, your returns are going to be lower. And that's just the way bonds work. Now, they're very sensitive to interest rates. Okay. Now, so why do people include bonds in their portfolios? Well, a couple of reasons. The first one is that uncorrelated assets are generally a good thing in your portfolio. And the correlation between high quality bonds and stocks is about zero. That's a good thing, right? For example, the correlation between US stocks and international stocks is like 0.8, right? That's dramatically higher than zero, which is what you get with the bonds. So that correlation is a good thing. When stocks zig, bonds are much more likely to zag. Right? So you get that benefit of a diversified portfolio. You also get a less volatile portfolio because bond returns, whether positive or negative, tend to be much more muted than stock returns. Adding some into the portfolio of stocks decreases volatility. That makes it easier to hold the portfolio in a nasty market downturn. And you simply become better at buying and holding and staying the course. And so it's really important. The worst thing you can do is put all your money into stocks and then panic sell in a bear market, right? Because most bear markets will resolve themselves in a year or 2 or 3 or 5 or whatever, right? And if you panic sell and you sell at the bottom, especially if you do this late in your career, it's very, very hard to recover from that financially. Okay, so the key is to not overestimate your own risk tolerance. And until you know what your risk tolerance is, you're probably better off erring on the side of too conservative of a portfolio. Heaven forbid you start out your life with a 60-40 portfolio. You go through a bear market or two and you're like, that's really no big deal for me. I totally get this long-term thing. I'm going to now bump it up to an 80-20 portfolio. I think that's a much better way to do it than to start out as 100% stocks because somebody told you you should be 100% stocks. And then you panic in your first nasty bear market and you don't even invest anything in the stocks for the next 20 years. That is a much bigger tragedy than if you just held a little bit too much in bonds in the beginning. So I generally counsel people, figure out what you think you ought to be, dial it back just a little bit until you go through a bear market. It really doesn't matter what your returns are the first 2 or 3 or 5 years anyway, right? It's all about how much money you're putting into your accounts at that point. And, so if you get a little lower return, it's really no big deal. And figuring out your risk tolerance is far more important in those situations. Okay, another reason why bonds can be good is because it's possible for bonds to outperform stocks, even in the very long term. Okay, now historically, if you look back in the US, I think there still hasn't been a period of 20 plus years where bonds outperform stocks. That's not necessarily the case in other countries. And even in the US, I think there's been a 10 or 15 year period or two where bonds did outperform stocks. For example, look at the quote unquote lost decade of the 2000s, right? The return on the S&P 500 in the 2000s was pretty darn close to zero. I think it was slightly over zero. But from 2000 to 2010, that's basically what it was. Now, part of that is because that included the tech meltdown of 2000 to 2002, and it included the global financial crisis in 2008, 2009, right? So you get two big, huge, bear markets in a 10-year period. And well, guess what? Stocks didn't do that awesome. Well, bonds did a lot better over that 10-year period. And that can happen for longer periods of time. There's no guarantee that stocks will outperform bonds in the long run. That is not a guarantee. And so that's another benefit of bonds. Something else that's available with bonds is they can be indexed to inflation, right? There are I bonds, you can do that. TIPS, you can do that. You can't really index other asset classes to inflation, right? I mean, in the long run, gold seems to keep up with inflation more or less. Your ounce of gold bought a nice man's suit 800 years ago. It buys a nice man's suit today. It basically, keeps up with inflation. But not in any sort of short-term way. Although, to be fair, TIPS don't necessarily correlate perfectly with inflation either. People go back and they look at 2022 and they see, oh, wait, TIPS went down in value in a year when inflation was really high. Well, that's true because real interest rates went up, and interest rates have a much bigger effect on the value of your TIPS than the inflation adjustment each year does. And so that is true. Now, did TIPS do better than nominal bonds that year? Yes, they did. But they certainly didn't, do awesome in a year with pretty high inflation. So keep that in mind as you buy bonds. Now, you can buy individual bonds. I generally only recommend people do that with treasuries. Okay? If you're buying municipal bonds, you're buying corporate bonds, you're buying mortgage-backed bonds, I think you need a diversified portfolio of them. I think you probably ought to use a bond fund. But there are some benefits to just buying individual bonds, right? When it's going to mature. You're not going to have a loss of principal, at least on a nominal basis, if you do that. So some people make a bond ladder, for example. They want to have a certain amount of money to spend every year. And so they start building this ladder of bonds that mature every year for 5 years or 10 years or 30 years. A lot of times they'll even use Treasury inflation protected security, a TIPS, to do this. And then they know they'll have that amount of money in real dollars at that date. And that allows them to, have some guarantees in their income and what they can spend throughout their retirement. And they like that. It's also fine to just use a bond fund. It's a very simple way to do it. But bear in mind, there is a possibility that you get hosed if all the other investors bail out of a bond fund and they end up having to sell bonds low, and that can hurt you as the remaining person in the fund. And of course, there is also the possibility to lose principal in that bond fund because the fund itself, to maintain its its plan, its method of investing, maybe it's trying to hold bonds of a certain maturity. They may end up selling bonds low as well and buying new ones to replace them. So the managers can cause you to lose principal in a bond fund, which you wouldn't if you held an individual, treasury bond to maturity. So for those reasons, some people, would prefer to have a little more complexity in their life, manage a portfolio of bonds themselves, individual bonds, rather than having a bond fund manager do it. I think most people just lean toward keeping it simple and using a bond fund like BND. I think that's a perfectly fine bond fund. It owns all the corporate bonds in the U.S., all the treasury bonds in the U.S., all the mortgage-backed bonds in the U.S. It's a very diversified bond portfolio. And I think it's perfectly reasonable to have it be part of your or your parents' portfolio. Now, in general, most people reduce the volatility, the risk of their portfolio as they approach retirement. Those are the most important years for your returns. If you've heard of the phrase sequence of returns risk, that's what we're talking about. The last few years before you retire, your first 5 years or so in retirement, having bad returns then, especially while you're also withdrawing from the portfolio, can have a big impact on how much you can spend in retirement and whether you run out of money in retirement with a certain level of spending. So a lot of people do dial back the risk in those last few years before retirement and the first few years in retirement. And some people continue to dial back that risk throughout their retirement. There are some good arguments for and against that practice. But for the most part, that's the time to be thinking about some way to deal with sequence of returns risk. And for a lot of people, the way they do that is just by having a little bit more money in bonds or by building a bond ladder, like I discussed. So I hope that's helpful to you. You probably ought to get some bonds into your parents' portfolio if you're helping them to manage it. You never know when a big, nasty stock market crash is going to come that isn't going to come back for a decade. It could happen. And, having some bonds in there that aren't necessarily going to do that may be a good way to continue to survive financially in the event of something like that. Hope that's helpful. Next question comes in by email. It says, I'm a longtime follower of 10 plus years and a fellow emergency physician, now turned intensivist. Is bond interest for a high earner, a modified adjusted gross income of greater than $250,000, essentially taxed at a higher rate than ordinary income due to the additional NIIT? Okay, so let's talk about NIIT, right? This is Obamacare tax, for lack of a better term, PPACA tax. And the way it works, okay, is that if you go earn money, and it's more than $250,000 a year, you pay 2.9% in Medicare tax on that money, plus 0.9% in Obamacare tax, for a total of 3.8%. If the money is unearned, like from bond interest, you pay 3.8% in NIIT. Okay, so it's the same. Whether money is earned, whether the money is unearned, if it's ordinary income, you're going to pay the same amount of money. So no, bond interest is not taxed higher than your ordinary income is. That said, if you're in a higher income tax bracket, you probably ought to look into whether it's worth investing in municipal bonds, right? Municipal bonds are federal tax-free. If it's a municipal bond from your state, it's also state income tax-free. And for those in higher brackets, a lot of the time, the after-tax yield on municipal bonds is higher than you will see from non-municipal bonds. So I hope that's helpful to you. Okay, another question comes in by email, a couple of questions actually, about retirement numbers. I understand picking a number to aim for retirement and the rough calculations on how to achieve it, what my income would be based on that target, but I'm lost as to how to best estimate what the target should be. Sure, I can do 25x, but I am early career earning $400,000 on a W-2 a year and have trouble imagining what I will need or want to live on when retirement ultimately hits. So any help or tips or tricks would be greatly appreciated. This is what happens when you start planning for retirement early, right? I'm a big fan of you planning for retirement early. I'm a big fan of you starting to save for retirement early. I'm certainly a big fan of you becoming financially literate and learning how all this money stuff works. The problem is some of us by our very nature are super planners, okay? And we want to plan out every detail of what our life's going to be like 30 years from now. And we got to just relax. We got to just relax and realize things can be adjusted as you go along. Okay, so pick something you think is reasonable and change it when you think change is warranted. Okay, expect your tastes and your spending to rise a little bit if you're like most people. Let me give you an example. Katie and I wrote up a financial plan in 2004, right? I was finishing my PGY 1 year, maybe it was the start of my PGY 2 year. That's when we wrote our financial plan out. The amount of money we thought we needed at that point in order to have enough to never have to work again was about $2.7 million in 2004 dollars. That works out to be like $4 million today with inflation. Well, as we got close to that and exceeded that, we realized, you know what, we kind of do like spending a little bit more money. And so our number using the 25x, rule of thumb had to necessarily go up as we decided we liked spending more money than that. And that's probably the case for lots of people. So pick something reasonable and change it when you think change is warranted. Okay, the second question says, my spouse is a stay-at-home right now. I plug some random incomes into the Social Security calculators, and it seems that even with a modest income, arbitrarily picked at $5,000 a year, you could pay minimal self-employment taxes and collect over $3,000 a month in Social Security, assuming you wait the full retirement years. Is it worth it for my wife to create a solo gig that she makes and reports a minimal income to collect Social Security payments when we retire? Any magic minimum numbers to hit? Well, the problem with this plan, which is not a terrible plan, but there is a big problem with it. The problem is that the alternative is pretty good and takes zero work. Okay? It appears that this questioner did not realize that your stay-at-home spouse qualifies for half of your benefit at full retirement age, right? Just based on being married. Okay? So if you got a doc working and a stay-at-home spouse, right, the doc's going to get 100% of their benefit. The stay-at-home spouse is going to get 50% of the doc's benefit. So that's pretty darn good. A doctor's that works for 30 years is going to have a pretty high Social Security benefit. And half of that is still better than a whole lot of people have. And if the doc dies first, well, the spouse gets the doctor's benefit, not the half of the doctor's benefit. And so it goes down from 1.5 of the doctor's benefit to, 1 of the doctor's benefit. But that's pretty good, right? That's the alternative for the spouse never going to work, never earning anything, not starting this minimum solo gig thing. Okay, so that much is true. That said, Social Security is somewhat progressive, right? The return on your investment in the beginning is pretty darn good, right? They talk about bend points with your Social Security benefits, and I think I'm just now passing the second bend point in my career. Katie's nowhere near the second bend point in her career, but she's now got a benefit that's more than half of my benefit, projected out. And so the amount of work that she's done has earned us, a little more money than what we would get if she were just getting half of my benefit. And so this can make sense, especially if your spouse actually wants to work and wants to work a significant amount. But if your spouse just works a little bit and gets that kind of minimum Social Security benefit, just barely gets the 40 quarters in, this is probably not going to be more than 50% of your benefit. So I think I probably wouldn't bother. That said, if your spouse wants to go work for other reasons, this could be one of the benefits of doing that. Hope that's helpful. As I mentioned in the beginning of the podcast, SoFi could help medical residents like you save thousands of dollars with exclusive rates and flexible terms for refinancing your student loans. Visit SoFi.com/whitecoatinvestor to see all the promotions and offers they've got waiting for you. One more time, that's SoFi.com/whitecoatinvestor. SoFi student loans are originated by SoFi Bank, N.A., member FDIC. Additional terms and conditions apply. NMLS 696891. All right. Thanks for those of you leaving us 5-star reviews and telling your friends about the podcast. A recent one came in that said, jump-started my financial education. Love the show. Only wish I found it sooner. Great primer to stimulate learning about finances for a doc, especially for someone who isn't quite ready to dive into reading a few financial books. 5 stars. Great. I appreciate that review. That does help get the word out to others about this podcast. Don't forget, if you're interested in doing paid surveys, go to whitecoatinvestor.com/survey. Heaven forbid you don't have any surveys for you. It's not like it takes you a lot of effort or trouble to apply for these things and see if you get screened out of them. Some of them are even starting to pay you a few bucks when you do get screened out of the surveys, which I think is a nice change we've been pushing these companies to make for doctors, because people get really bitter when they spend 5 minutes trying to see if they qualify to actually take the survey, and then they don't, and they don't get paid for their 5 minutes of time. So now you get a few bucks at least for those 5 minutes of time with some of the survey providers. Let us know if you're having a good experience with them. Let us know if you're having a bad experience with them. We'll take them off the list and replace them with people that are going to treat white coat investors right. All right. Thanks for being here. Keep your head up, your shoulders back. You've got this. We'll see you next time on the White Coat Investor Podcast.
The hosts of the White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.